You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast. Today, we're unpacking a really complex market environment. You've got this economic fragility bumping up against some serious geopolitical tension. It's, well, a rare mix of risks right now. And the core story really is this defensive move we're seeing. I mean, gold is shining. It's testing these, extreme psychological levels near that $4,000 mark.
Right, 4,000, and oil steadied above $60.
Yeah, but despite that, the appetite for risk in equities still feels incredibly fragile.
Oh, definitely. And that fragility, it's being driven by a sort of 1-2 punch. First, you've got this fresh look at the soft U.S. labor data, specifically those surging challenger job cuts, lower private employment estimates. It's all really solidifying the view that the U.S. economy is losing steam. And that's keeping the dollar index kind of subdued below 100. And then second, this economic worry gets amplified by these renewed U.S.-China tech tensions. Washington reportedly blocking Nvidia's scaled-down AI chips going to Beijing.
Yeah, I saw that.
That's put the whole tech Cold War narrative right back in focus, and it's really hammered semiconductor sentiment.
So over the next few minutes, we are going to analyze how these traditional safe haven assets, like the yen and gold, are benefiting. And we'll break down the geopolitical flashpoints, too. The Middle East, Ukraine, that are feeding into this rush toward, defensive positioning.
We'll also try to make sense of some conflicting trade signals, like China's confusing move, suspending certain rare earth export controls. What does that even mean for industrial metals? And, where might the next big market move actually come from?
Let's get into it. Okay, so let's start where a lot of this volatility seems rooted right now. The U.S. dollar and the state of the American economy, the dollar index being stuck below that key 100 mark. It really tells you something, doesn't it?
It does. It says the market is now, absolutely convinced the Fed is finished hiking rates. Full stop.
And that conviction comes from the labor picture.
Entirely, yeah. We've seen these data points, like you mentioned, that surge in challenger job cuts, the softer private employment numbers that seem to go beyond just a minor slowdown. This feels like the evidence traders were waiting for to fully price in the end of the tightening cycle.
Right.
And that immediate pressure on the dollar just automatically translates into a bid for defensive assets everywhere else.
Okay, so the dollar weakness boosts traditional safe havens. The Japanese yen, for instance, we're seeing it stabilize around, 153?
Around there.
But given all the noise recently about inflation in Japan, policy divergence, why is it stabilizing at a relatively weak level like 153? Shouldn't we see a bigger rally if it's a safe haven? What's pulling it in the other direction?
Yeah, that's the nuance, isn't it? The yen is really caught in this tug of war. So, yes, it's benefiting from those haven flows. Investors are definitely fleeing some dollar risk.
Yeah.
But that's only offsetting its underlying structural weakness. I mean, the Bank of Japan is still a huge outlier with its ultra-loose policy, right?
Right.
And that yield differential between Japan and, say, the U.S. is still punishing for the yen.
I see.
So 153 is kind of the equilibrium point right now, where those high yields abroad and the defensive capital looking for preservation, they're sort of neutralizing each other.
Got it. Now, beyond the jobs data, it feels like the return of this strategic trade friction is really spooking investors. That's driving those haven flows too, right? The U.S.-China tech Cold War heating up again over advanced chips.
That's absolutely right. Washington is reportedly blocking Nvidia from exporting those, scaled-down AI chips to Beijing.
Yeah.
And what's fascinating here is the signal it sends.
Which is?
That the strategic decoupling isn't easing up. If anything, it's accelerating. Washington clearly views control over advanced semiconductors as a fundamental geopolitical tool. And this latest restriction, it's hitting semiconductor sentiment hard right across Asia.
It feels like we're moving past just tariffs now and more into direct strategic tech warfare. So when the U.S. doubles down like this, how does China try to counter or, lessen the pain? Because their signals have been incredibly mixed lately.
Mixed is putting it mildly. I mean, on one hand, China's Commerce Ministry suspended certain rare earth export control.
Right, the rare earths.
But is that a genuine move towards de-escalation? Or maybe just a strategic head fake? Trying to appease trade partners while the pressure is mounting elsewhere.
Okay, so what makes you skeptical?
Well, at the same time, we get confirmation that the White House is pushing this massive, $35 billion investment deal with Uzbekistan specifically to diversify critical minerals away from China.
Ah, okay, so the timing is interesting.
Exactly. So the market is looking at China's rare earth move with, let's say, deep skepticism.
So the signal is just confusing. A small olive branch on rare earths, maybe, but the underlying strategic tension and this global scramble to decouple supply chains, that's clearly getting more intense. And this kind of chaos is reflected in other G10 currencies too, isn't it?
Indeed. The euro, perhaps surprisingly, is holding up near 1.1550. Seems like it's buoyed by just steady, predictable commentary from the European Central Bank. No big surprises there.
Okay.
Sterling's also holding its ground around 1.31 after the Bank of England decision. Remember that dovish 5-4 split? They left the policy rate unchanged.
Yeah, close vote.
Right. But the key takeaway was, despite that internal division, no immediate shift is expected.
Yeah.
And that's allowing sterling to just stabilize for now.
And what about the commodity currencies? The ones tied more directly to global demand and trade, like the Aussie and Kiwi.
They're really showing that conflicting pull, between defensive flows and trade optimism. The Australian dollar is actually gaining a bit.
Oh, really? Why?
It's a direct benefit from firmer metals prices we've seen lately. Suggests some commodity demand is holding up, at least for now. But on the other hand, the New Zealand dollar is clearly underperforming.
And that's linked back to...
Tied directly back to cautious sentiment about Chinese trade weakness. The world really needs clarity from Beijing on the economic front. Until then, these demand-linked currencies are just vulnerable.
Let's pivot then to commodities themselves. They're often the clearest barometer of immediate investor fear, right? And gold is the defining story here, clinging to that $4,000 an ounce mark mentioned in the analysis. Now, we have to address the elephant in the room.
Go on.
That price level, $4,000. It sounds wildly speculative for spot gold right now. What does the market even mean when it pushes gold towards such an extreme figure? Is that real?
Yeah, that specific number, $4,000, it tells you the analysis is likely capturing some extreme risk aversion scenario. It's probably tracking a highly defensive, maybe far-out futures contract, or perhaps a target level someone's put out there, rather than the current spot price, which is, closer to $2,000.
Okay, so it's more symbolic of the fear level.
Exactly. But the underlying insight is the same. The resilience of the yellow metal, even around $2,000, confirms that capital is flooding into what's seen as the ultimate hedge against systemic risk. When geopolitical tensions surge, especially things concerning the Middle East, and the dollar softens, gold is just the natural, immediate place for capital-seeking preservation.
Right. Meanwhile, oil has also shown surprising resilience. WTI and Brent crude are holding above $60 and $64 respectively. They seem to have recovered from that broader equity sell-off. Why is crude holding firm when we have these clear demand headwinds, like Saudi Arabia cutting prices recently?
It's almost entirely a supply-side story overriding those demand concerns right now. The key headline here is the confirmation of that Ukrainian drone strike on Russia's Volgograd refinery.
Ah, the refinery strike.
Yes. That direct hit on energy infrastructure, combined with sort of simmering expectations of a potential dip in Russian oil exports from Western ports this month. It puts supply disruption front and center. Geopolitical action is essentially sustaining this price floor above $60, almost irrespective of the softer demand data.
That constant physical supply risk, that seems critical. So if we connect this Volgograd strike and the tech war blockade to the bigger picture, the market isn't just pricing in financial risk anymore, is it? It's pricing in actual physical supply destruction and potential regional conflicts popping up everywhere.
Absolutely. Just look at the Middle East remains highly tense. We're seeing Israel declaring the Egypt border area a closed military zone. That just layers more regional security risk onto the existing volatility. And meanwhile, you have these reports about former President Trump commenting that Iran has apparently requested sanctions relief very soon. Who knows what that means, but it adds to the uncertainty. All this demands a risk premium be baked into energy prices.
And the Russia-Ukraine situation shows no sign of cooling either. Reports that Ukraine is in, quote, positive talks to get advanced long-range weapons like Tomahawk missiles. That signals a clear escalation, doesn't it?
Undeniably.
Yeah.
And that escalation has direct financial consequences. Russia's response is likely to harden its oil infrastructure defenses, which ironically might lead to more attacks like the Volgograd strike.
Right.
Plus, Western nations are keeping up the financial pressure. Washington just reiterated it won't license Russian energy trading firms. So when you layer this ongoing military and financial warfare onto, say, the domestic U.S. political gridlock over government funding, you get this potent mix of policy uncertainty and market fragility. And that just fuels defensive trades.
Okay, so given all this tension, this uncertainty,
Yeah.
what's the fate of industrial metals? Copper, for instance, the classic economic bellwether. It seems kind of stuck, doesn't it? Oscillating between roughly what, 10,680 years and $10,750 per ton. Feels range-bound, like it's waiting for something.
That's a perfect way to describe it. Copper is basically battling between two opposing forces. On one side, you have the hard reality of weak Chinese exports that's a major demand drag. But on the other side, you have that modest, maybe cautious optimism generated by that rare earth policy easing from China we talked about earlier.
So traders are just waiting.
Pretty much. They aren't panicking, but they're definitely waiting for a new, clear catalyst.
Yeah.
They need to see if Beijing's easing signals actually translate into real factory orders, or if the broader global slowdown really takes hold and pulls copper down. It's stuck in limbo.
And that caution seems to reflect the overall market sentiment perfectly. U.S. equity futures remain, well, flat to slightly lower, right? Following that pretty steep tech-led sell-off we saw.
Yeah, and those AI-sensitive names, in particular, are bearing the brunt of Washington's new export restrictions on those Nvidia chips.
So the whole tone feels like a decisive move towards capital preservation.
Absolutely. Safe haven assets, gold, the yen, U.S. treasuries, they're all seeing firm bids.
Yeah.
Investors are clearly tightening their exposure, seeking safety ahead of, upcoming sensitive data releases, particularly consumer sentiment figures and any fresh commentary from the Federal Reserve.
So it really seems the defining narrative right now is the market waking up to the fact that these economic headwinds are colliding head-on with some pretty extreme supply chain and geopolitical risks. We're kind of shifting from a growth-focused world to one focused purely on capital preservation.
I think that's right. The convergence of these supply chain risks, both the technological ones like the AI chip ban and the physical ones like that Volgograd refinery strike, it feels like it's setting the stage for the next major market move. That underlying tension is really what you should keep an eye on going forward.
Well, we really appreciate you tuning in and exploring this complex environment with us today.
That's it for today. Join us again soon on the Financial Source Podcast.